There's $1.5 trillion of debt maturing on commercial real estate and then by 2025. So they're about to start feeling pain. These lenders are spooked. There's no lending going on. There's no transactions going on. And it's going to be ugly. I mean, it's going to be at least as bad as 0809.
We've seen the bank collapses this year. What's the next big Lehman-like crisis to hit America? Well, it could very well be the current disaster that's happening in the commercial real estate sector. All across America, from Dallas to San Francisco to New York to Los Angeles, offices sit vacant or very minimally used, showing the current staying power of the work-from-home era introduced during COVID. This new work lifestyle is likely to remain for the immediate future.
82% of employers today, of Manhattan office employers, 82% say that hybrid work is their future plan. Before the pandemic, that number was 6%.
Just look at New York City, America's largest commercial real estate zone, which is currently experiencing the most unused commercial buildings in 3 decades. Columbia University and New York University estimated that lower tenant demand because of remote work, they cut 28% or $456 billion off the value of offices across the US. About 10% of that would be in New York City alone. Vacancies reached a record 22.7% this year, after decades of an average rate that never surpassed 11% a year. The city's budget experts say the vacancy rate won't dip below 19% before at least 2026. Some landlords are defaulting on debt as borrowing costs surge and the prospects of filling up office towers wane given the rise in remote hybrid work. Those trends weighed on values, with prices on high-quality office properties falling about 25% in the last year. And this at the same time as New York is recovering from the pandemic, residential rents are surging and tourism is back. However, offices remain empty or at best very minimally used. Asking rents in Manhattan offices averaged $75.13 per square foot in April 2023, down 50 cents from a year prior. It's a worry for city officials who for the last decade have relied on the ever-expanding commercial real estate sector for taxes to pay for schools, cops, and trash collection. Commercial property taxes contribute about 20% of a city's total tax revenue, with office buildings specifically contributing 10%. In the 8 years before the pandemic, tax revenues grew an average of 4.7% per year, roughly due to the commercial real estate sector. A section on Manhattan's 3rd Avenue from 42nd to 59th Street shows a real issue. While New York has bounced back to a certain extent after COVID, the corridor has 29% of office space available for tenants, nearly double the amount 4 years ago and above the city's overall rate of 19%.
Los Angeles may be a smaller office market than Manhattan, which we talk about so much, but it has even bigger problems. The office vacancy rate in LA soared to 22.5% in the first quarter, compared with Manhattan at 17%. This represents 50 million square feet of empty offices, about 61% more than pre-pandemic.
Just earlier this year in LA, Brooksfield, the parent of the largest office landlord in downtown Los Angeles, defaulted on loans tied to 2 buildings rather than refinancing the debt as demand for space weakens in the center of the 2nd largest US city. With downtown LA's office vacancy rate at a record 30%, buildings have plunged in value as workers stay away from the urban core of a sprawling, car-centric region. More than $900 billion of debt on US commercial real estate is set to mature through 2024, and much of it will be refinancing at interest rates that have more than doubled since early last year. Offices are in a particularly dire situation. Values for top-tier properties have plunged 25% in the past 12 months, while the broader office market is almost 40% below pre-COVID levels, according to Green Street, a real estate analytics provider. It wasn't just LA either, as Brooksfield also defaulted on a $161.4 million mortgage for a dozen office buildings, mostly around Washington, D.C. This is the same story across all of America. This chart shows a drastic increase in office vacancies since 2019 across America. Among the dozen buildings in the Brooksfield portfolio with the $161 million debt, occupancy rate averaged 52% in 2022, down from 79% in 2018 when the debt was underwritten. In Washington metro area, office property values have plunged 36% through March from a year earlier.
San Francisco is enduring its worst vacancy crisis on record. More than 18 million square feet of office space completely empty. It's not the only one. Real estate analysts are expecting vacancies to rise even further as leases are set to expire in the coming years.
San Francisco, once a hub for innovation and technology, is facing a complete collapse. In some cases, it's estimated that property values could plummet over 80%. With people continuing to work from home, San Francisco's commercial real estate is struggling to survive. Amidst this slump, the Union Bank building at 350 California Street may well become a symbol of the city's post-pandemic property struggles. As originally reported by SF Standard, the building was valued at around $300 million just 2 years ago. But as it went on sale in 2020, the price dropped to approximately $250 million, with final offers reportedly coming in at a staggering $60 million. This commercial real estate crisis is not good news for America's banks. Most of the banks that hold commercial real estate mortgages are small to mid-sized banks that experience the brunt of the current banking collapse. Smaller banks began ramping up their exposure to commercial real estate in the aftermath of the 2008 financial crisis, which was triggered by a housing bust, and stuck with it even after the pandemic emptied out many city centre properties and other forms of borrowing provided by commercial mortgage-backed securities and life insurers dried up. We all remember Signature Bank, one of the casualties to the current banking collapse. Signature was among the banks that made some of these bets, becoming an aggressive lender in New York City to office towers and multifamily properties. By the end of 2022, it had amassed nearly $36 billion in commercial real estate loans, half of which were in apartments. The portfolio comprised nearly 1/3 of its $110 billion in assets. Commercial real estate prices are falling. This graph shows that commercial real estate prices fell 1% in the last quarter. I know that doesn't seem as much, however, this is the first drop in a decade. As you can see with this graph, the banking industry's exposure to commercial real estate accelerated during the pandemic. More than 80% of all commercial real estate loans are now held by banks with fewer than $250 billion in assets. This is very concerning as we expect more and more distress in the sector, which could have further ramifications for the banking industry. Jamie Dimon just stated that the commercial real estate sector is the next big area at risk of a major financial shock. Of course, the major banks of America are likely to come out of this relatively unscathed. However, with more than 80% of all commercial real estate loans being held by banks with fewer than $250 billion in assets, many smaller banks will be hit hard. Banks held more than $700 billion in loans on office buildings and downtown retailers in the fourth quarter of last year, according to the Fed. More than $500 billion of that was extended by smaller lenders. So we see that the sector is in big trouble. Now what's next? From top financial analysts to Wall Street banks, a growing chorus of the experts is warning that commercial real estate could be where the next cracks appear. Higher bank costs and tighter credit conditions caused by the banking jitters could raise hurdles of big property owners as they seek to refinance a pile of loans. Nearly $450 billion in commercial real estate debt is due to mature this year, meaning a final payment on these loans are due. The Federal Reserve has raised benchmark interest rates to 5% currently, from almost zero 12 months ago. That's the steepest jump in US borrowing costs since the 1980s. What's making things worse is the fact that occupancy rates in offices across the country are still far from pre-pandemic levels, thanks to remote work trends, and that's weighing on property valuations. Against the backdrop, odds are on the rise that commercial property owners could default on their debt. Elon Musk even tweeted that this was the most serious issue looming. JP Morgan expressed the biggest warning of them all. We expect about 21% of commercial mortgage-backed securities outstanding office loans to default eventually, with a loss severity assumption of 41% and forward losses of 8.6%. Applying the 8.6% loss to office exposure, it would imply about $38 billion in losses for the banking sector. At the medium US bank, Commercial real estate loans account for 38% of loan holdings, according to an analyst by KBW Research. The good news is that banks lent more conservatively in recent years compared to the period before the 2008 financial crisis. Many buildings might still be worth more than their mortgages, even if they suffer a loss in value. We are seeing that the next big Lehman moment could very well be in the commercial real estate sector. Let us know in the comments what you think is next for the commercial real estate sector and how bad is it actually.